Short-term rentals are the real estate strategy of 2026. Every platform says it. Every real estate influencer is building a portfolio around it. Every coaching program is selling the Airbnb arbitrage model as the accessible, scalable, high cash flow entry point for the modern real estate investor. And the numbers they show are genuinely compelling. $3,000 a month from a single property, 60% occupancy, producing more cash flow than a traditional long-term rental at 100% occupancy, the ability to use a property personally, price dynamically, and scale without the landlord-tenant obligations that make traditional rentals feel like a second job. The people promoting this model are not fabricating the results. The case studies are real. The income screenshots are legitimate. The strategy, executed correctly in the right market, genuinely produces the returns being advertised. But they are describing peak performance in optimal conditions, and almost nobody is talking about what the strategy actually looks like in the market environment that exists right now in 2026 for the majority of investors attempting to replicate it. If content like this interests you, please hit the like and subscribe button so you don't miss our next video. But nobody ever asks the obvious question. If short-term rentals are producing the returns being advertised, if the Airbnb arbitrage model is as accessible and scalable as every 2026 coaching program claims, then why are short-term rental revenue metrics declining across the majority of major U.S. markets simultaneously? Why are occupancy rates compressing in the exact cities and vacation markets that generated the case studies everyone is replicating? Why are investors who entered the short-term rental space in 2023 and 2024 quietly listing properties for sale at volumes that analyst platforms are now tracking as a measurable trend? Not because the concept is flawed, because there is a specific hidden variable nobody mentions before selling you the model. Short-term rental returns are not a strategy. They are a market condition. And the market condition that produces results in every case study you've been shown has changed, materially, measurably, and in ways that directly impact every projection being used to sell the strategy right now. That distinction is the question nobody is asking, and the answer determines everything. Here is the actual data. According to AirDNA, the primary analytics platform tracking short-term rental performance, average revenue per available night across U.S. short-term rental markets declined by 12% to 18% between 2022 and 2025. Occupancy rates in the top 50 vacation markets dropped from a pandemic-era peak of 68% to current averages hovering between 51% and 57%. In previously high-performing markets like Scottsdale, Nashville, and the Smoky Mountains, active listing inventory increased by 40% to 70% over the same period, meaning significantly more properties competing for a shrinking pool of bookings. The math that made the model work at 65% occupancy with $250 average nightly rates does not work at 52% occupancy with $195 average nightly rates, especially when a mortgage on the acquisition was underwritten at 2022 interest rates that no longer exist. Most investors entering the short-term rental space in 2026 are underwriting deals using revenue projections pulled from peak market case studies, then discovering actual performance lands 25% to 35% below projection within the first operating year. That gap is not a rounding error. It is the difference between positive cash flow and a monthly subsidy that compounds against your financial position every single year. So, why does everyone keep recommending short-term rentals when the performance data tells a clearly different story? Because the education cycle lags a market by 2 to 3 years, and the people selling the strategy have no financial incentive to update the narrative. The coaches, the courses, the YouTube channels built around short-term rental investing accumulated their audiences during 2020 to 2022, the most anomalous short-term rental performance environment in recorded history. Pandemic-driven travel shifts, suppress hotel inventory, and remote work flexibility produce occupancy rates and nightly prices that had never existed before and have not been sustained since. Those peak market results became the curriculum, the testimonials, the thumbnails, the income screenshots that now sell $2,000 courses to investors underwriting 2026 acquisitions against 2021 performance data. There is also a platform incentive problem running underneath this. Airbnb, VRBO, and every affiliated tool, lender, and property management company in the short-term rental ecosystem profits from new listings regardless of whether those listings perform. More inventory benefits the platforms. More courses benefit the educators. More acquisitions benefit the lenders. The only party whose financial outcome depends entirely on whether the strategy actually works in 2026 is you. Here is what actually drives short-term rental profitability, and why it operates completely differently than the courses suggest. Short-term rental returns are not determined by the strategy. They are determined by 3 market-specific variables that exist before you acquire a single property and cannot be manufactured after the fact. Variable 1, supply saturation. Profitable short-term rental markets are those where active listing inventory remains below local demand capacity. Once saturation crosses a threshold, every new listing competes for the same finite booking pool. The investors who enter before saturation capture the returns. The investors entering now are splitting a smaller pie into more pieces. Variable 2, regulatory trajectory. Over 50 major U.S. cities have implemented or are actively legislating short-term rental restrictions since 2023. The profitability of an acquisition made today depends partly on the regulatory environment that exists in that market 2 years from now, a variable most investors are not modeling at all. Variable 3, entry price relative to realistic revenue, not projected revenue from peak market comps. Actual trailing 12-month revenue from comparable active listings in the same submarket at current occupancy rates, priced conservatively. When all 3 variables are analyzed honestly before acquisition, most markets currently available to a 2026 investor do not support the returns being advertised. A minority do. Finding that minority is the actual strategy. Here's a pattern that repeats among short-term rental investors with devastating consistency. Someone gets inspired by a case study, a specific property, a specific market, a specific investor generating $4,200 a month from a 2-bedroom cabin purchased 3 years ago. The numbers are real. The story is legitimate, and it is completely, dangerously irrelevant to the acquisition decision being made today. They underwrite the deal using that case study as a revenue benchmark. They pull Airbnb listing prices in the target market, not trailing revenue data, listing prices, and project occupancy based on peak season performance rather than annual averages. The pro forma looks compelling. The lender approves a loan. The acquisition closes. Month 3 arrives. Actual occupancy is running 14 points below projection. The cleaning fees that look like a minor line item are consuming 11% of gross revenue. A competing property 2 streets overdropped nightly rates by $40 to fill their calendar, and the investor matches it to stay competitive, compressing margins further. By month 8, the property is cash flow negative, not dramatically, just consistently. $300 to $600 per month flowing out rather than in silently compounding against every financial goal the acquisition was supposed to accelerate. The mistake was not the strategy. It was applying a 2021 case study to a 2026 market without adjusting a single assumption. Here is the exact due diligence sequence for any short-term rental acquisition in 2026. In order, without shortcuts. Step 1. Pull trailing revenue data, not projections. Use AirDNA or Rabu to find actual gross revenue from comparable active listings in your specific target submarket over the last 12 months. Not peak season. Full year. If comparable properties are generating 25% below what the seller's pro forma projects, the pro forma is wrong, not the data. Step 2. Research the regulatory pipeline before underwriting a single number. Search your target city's municipal agenda for short-term rental ordinances introduced or pending in the last 18 months. One zoning change can convert a cash flow positive asset into an illegal operation overnight. Regulatory risk is not a footnote. It is a primary underwriting variable. Step 3. Stress test at 45% occupancy, not the market average. Below it. If the deal does not survive 45% occupancy at conservative nightly rates without requiring monthly capital from you, the deal does not survive the inevitable slow season, the platform algorithm change, or the new competing property that lists 2 blocks away next spring. Step 4. Compare the acquisition honestly against REIT performance. If a diversified real estate index fund delivers comparable returns with zero management burden and full liquidity, the direct ownership premium must be clearly justified before a single dollar commits. Here is the honest assessment nobody in the short-term rental space is volunteering in 2026. The strategy is not dead. Short-term rentals will continue producing strong returns for investors who identify undersaturated markets, underwrite conservatively against real trailing data, and acquire at price points that survive current regulatory and competitive risks. But that investor profile is significantly narrower than the courses suggest. The due diligence required to find viable deals is substantially more rigorous than what most first-time investors are being prepared for. Market normalization, supply saturation correcting, over-leveraged portfolios generating motivated seller inventory is 18 to 36 months away across most analyzed markets. That is not a reason to sit idle. It is a reason to build the analytical framework now. Identify target markets carefully and position capital conservatively until entry conditions actually support the returns being advertised. The investors who win are not the ones who move fastest. They moved most accurately. If this gave you a framework the courses didn't, subscribe. Because every week we cover strategies that match the market you are actually operating in.